in most of the ways that we trade and that sort of thing. And so it's always good to get a different perspective. And that's what those Wednesday sessions are usually for. But today you're stuck with me. So I hope that you're not too disappointed. But we're going to get into some really good stuff. I think today I'm going to try to lay out in a way that I've never laid out before that I hope is helpful. Really my core structure of trading. You guys have probably heard me say, trading with room for error, using defensive trading, using a line in the sand, all these terms, all these kind of concepts. And I'm going to try to give you a kind of a practical overview of that, hopefully in a way that's really clear for folks. So we will jump into that. By the way, I already saw some questions on opening Playbook VIP. Just so everyone is here on the same page, guys, opening Playbook is free. It's free every morning. It will always be free. Graham and I put a lot of work and time and effort into opening Playbook, but it is a kind of our gift to you, our value to you. The only reason there's a quote unquote VIP version is because we cover a lot of ground, do lots of trainings, have lots of trades, and we wanted somewhere kind of official to put all that stuff. And our team said, hey, you have to charge something to do it officially in a members area and also provide transactional emails, kind of official membership emails. So we charged $1 for it. So just, again, I know most of you are already VIP members, but I saw a couple questions there. That's what the VIP is. It's not a paid thing. It's not opening Playbook is, meant to be a trial and then you have to start paying for it. Nothing like that. It's just meant to give you kind of a home base for all the stuff that we cover.
And you get the recordings, training decks, scanners we build, the trades we share. We just post them in the doc. So it's just all centralized for you. I just posted the link in the chat for anyone who wants it. It is $1 for a lifetime. Intended to be as free as possible.
Forgot to mention lifetime access. So we'll do a little deeper thing on the VIP at some point because we haven't really covered it in depth here in a while. We'll show you guys the members area and all that kind of stuff and really break it down at some point in the near future. But for right now, we've got some important stuff to get to and try to dive through what I think is one of the more important tradings out there for kind of how to trade, especially in uncertain markets. So today's agenda is how defensive trading works, understanding risk reward and compounding returns. I think this risk reward combination is one of the more misunderstood components of how we trade. And so we're going to cover that. And then we'll do the income machine demo for anyone who hasn't seen the income machine or got a chance to start using it. I'll cover that as well today. Now, before we get started, since I am going to give some examples and we are going to talk about the income machine, we've got to do the legally compliant thing here and tell you that as I give examples, they're based on our live track record so far, looking back with a 93.3% win rate, 26% average return, 4.92 profit factor, all that good stuff. When I start talking about real trades, just so you know, that's what it's referencing, and I can share that track record here with you guys in a little bit if you want to see it. Also, later on as I go through, you will hear some of the stories that many of you submitted. Just to be very extra, super duper clear, we're not financial advisors. We didn't meet with people one-on-one and give financial advice. In fact, the whole point of what I've been building is to not do that so that you guys can make your own decisions and have all the power in your own hands. So just to be extra clear on that. So lately, you guys have probably heard me use some terms like defensive trade or cushion or room for error. Give me a yes in the chat if you've heard me say that and you're still not 100% sure what I mean when I say something like, hey, we have lots of cushion on the trade. Nate, what the heck does that mean? Well, today I want to break that down for you in practical terms and answer some of the common questions I get about trading in this particular method. So first of all, what is this style of trading? What is actually going on here? Simply put, I am taking positions below the current price of a stock, where as long as the stock remains above that level, I win. So let me just go ahead and actually post this in the chat because in simplest terms, this is what I want to do. I want to trade below the current price, but not just below it. I want to make sure I'm in a situation where anything above that level equals money for me. So, for example, let's take a look at a chart like this. Any random chart, Most people buy call options where the stock has to go up to make a profit on the trade. Okay. Or they buy a put option where the stock has to go down to make money. We would call that a directional trade. Obviously, the most common kind of trading. In fact, I would even go a step further and say most brokers love people who only have level one access so they can box you in to only trading this way. Buy calls, buy puts, and good luck. Now, the challenge with buying regular options is that you're battling timing, direction, and implied volatility all at the same time. Those things are all working against you at the same time in real time every time you buy a regular option, which means you don't just need the stock to go up. A lot of people are actually fooled into believing that they just need the stock to go up. That's wrong. You need it to go up a lot at the right time. And then, by the way, you need to make a perfect exit. Let me ask once again in the chat. I love getting interaction in the chat. How many of you guys not only struggle with the overcoming the implied move, but exiting on a regular call or put option? Because I know for me, when I used to trade more that way, it was probably the exits that hit me worse than the actual timing of getting into the trade. So you got to get all those things right. You have to get it to go up if you're buying a call, or down if you're buying a put. You have to get it to go up enough. And by the way, then you have to get the right exit, which is why some of the recent studies, it used to be that 76% study that I always share, which I still think is a powerful study from the Chicago Mercantile Exchange. But now some studies are showing that up to 90% of regular options lose money, which is just crazy. And by the way, that actually makes sense. Why? Because options trading has gotten so much more popular. And what do you guys think happens when option trading gets more popular? Supply and demand, those options gets more expensive, more implied volatility. Now you need a bigger move to overcome. More people lose money. The market makers make more money, so on and so forth. It makes sense that more and more people are actually losing money on regular options. That's why I trade most of my strategies, not every strategy, but I trade most of my strategies in almost the exact opposite way. Remember, a call option has to overcome a certain area just to have a chance at a profit. We call this implied volatility. It has to overcome that level before you even have a chance to make money. So while you might be entering the trade down here, your line in the sand to make money is usually all the way up here. All right? Makes sense? So you might enter the trade right here where that green candle starts, but that's kind of fake news. It doesn't really matter where you click buy. What matters is where you actually have to get in, which is that line in the sand. Okay? So hopefully that makes sense. And you have to overcome that if you're buying regular options. And by the way, you also have to time that significant move up, because if it makes the move too late, then you're still out of luck on that trade. So you have to overcome that move, and you have to have it with really good timing as well. What I am doing is flipping this around and using a line in the sand. Instead of above price that I have to overcome, I'm using a line in the sand below price, which flips this area that I have to overcome into that cushion that I was referring to. So when I say cushion, that green box is essentially what I'm referring to, which means price can go up, price can go sideways, price can go down a little, or actually it can even go down a lot and then bounce back up and still finish above the line in the sand. And I still win the trade in all of those scenarios. By the way, this is important. I still get the full profit on the trade in all of those scenarios. Okay, so when you're trading the way that I'm trading here, it doesn't matter if it finishes 1 penny above, or $1 above, or $2 above, or $4 above, or way up here, or way up here, or way up here. It doesn't matter which scenario it is. I get the full profit in every single scenario, which is really important when you're trading the way that I do with the line in the sand to understand. And this is really the cornerstone of how I trade, giving myself as many ways as possible on any given trade. And there are 3 main components to building out your trades like this. Okay, so guys, I'll put these in the chat. I would encourage you to write them down. I think they're really important. And if you don't take anything else away from today's lesson, hopefully you kind of get a better understanding of the practical reality of these three components. So, number one, how far below price do you go? How much cushion do you give yourself? How much time do you give the trade? In other words, what's your expiration date? How much time are you going to give it to go? And then most importantly, and this is the one that most people don't even think about, no one ever explains or really teaches this part, is this risk to reward based on the combination of number one and number two. What risk to reward, how much meat on the bone are you going to get based on the first two areas? All right, that's what we're going to cover. And again, I hope this is a little bit of a light bulb moment for you as we go through this. So the first question is, how far below price? How big of a cushion do you want? Do you want 1%, 2%, 4%, 5%, 9%? How much cushion do you want on the trade? Then, how much time to expiration? Do you want 7 days? Do you want 14 days, 21 days, 28 days, 35 days? How much time? Okay, so again, how deep, how much cushion, and how much time? That combination is what we're building on every single trade. And then most importantly, you get this question. And again, this is the one I think most people overlook, which is, what is the risk to reward of these combinations? If you go 7 days with time and then you go, 1%, or you go 28 days and you go 4%, or 35 days and 9%, you have all these different combinations and kind of sub combinations of that. What is the risk to reward? So for example, if you give the trade 7 days and 1% cushion, not a huge cushion, but a decent little cushion, you might get a 44% ROI. Okay? That's the relationship that time and the cushion have. Now, let me ask you guys a question. What happens if you want to keep 7 days? Okay, so you want to keep this intact, but you want to give it more room. Are you going to get better ROI or less ROI? Someone let me know in the chat. You want to hold the trade for 7 days, but you want to give it a big cushion, right? You'll get much less ROI. In fact, it will drop dramatically with a short date, because the market knows, hey, over the course of 7 days, no stock is likely to drop 6%. You're giving it a very small window to drop 6%. Your ROI is going to go from 44% at 1% to 2% when you give it 6% of cushion. Okay, so what if you keep the 6% cushion, but then you start giving it some more time, like 28 days? Oh, look what happens. Now your ROI went from 2% to 8%. Why? Because you use time to your advantage. You're still giving it that big cushion, but now you're giving it some more time. You're getting value out of the time component. Okay, so what if you keep 28 days, but then you give it a little more than the 1%, but a little less than the 6%? You give it a 3% cushion. Well, now you get a little extra juice, 22% ROI on that one. Or what if you give it 35 days and you give it a little extra cushion down here at 7%? Well, now you're right around a 14% ROI. So do you see how mixing and matching these combinations is what produces your ROI? Finding how much time you want to give it versus how much cushion you want to give it, depending on the stock, depending on the implied volatility, depending on what's going on in the news. All of those combinations is what's going to determine this number. And in my opinion, this number is really the whole kit and caboodle. This is really what matters. And it's what most people kind of skip over figuring out. For all those asking, if you just jumped in, you missed some of the meat and potatoes here, but that's okay. It'll be recorded, and you'll get access to that. Okay, now usually I would say, okay, guys, so you understand the fundamental ROI, risk combination. You understand all that. So next, what we're going to do is we're going to dive into the actual trade. We're going to go through different stocks, and then we're going to go through the option chain, and we're going to say, well, what happens if you go 1 week out with 1% below price? What about 2 weeks out with 1%? What if you go 3 weeks out with a 1.5% cushion? What if you go 4 weeks out with a 2.5% cushion? And we would just go through kind of a grueling analysis of just one stock to try to look at all these different combinations, right? And try to find the one that's best for us. Well, lucky for everyone on this call, we don't have to do that because the income machine does all of that for you. It's going to go through, it's going to find the income potential. It's even going to give you different paths: conservative, moderate, balanced, aggressive. It's going to give you all the dynamics, how much room you have on the trade, the exact options. All of that is going to be baked in. So if for some reason, some insane reason, you do not have the income machine yet, I will cover that later, okay? Because there's absolutely no reason for you not to have the income machine. You can get it and start using it for free for about 30 days with no credit card even required to use what I think is the most powerful tool ever built. So I will cover that in a minute for anyone. Let me know in the chat if you don't have the income machine, but I'm assuming basically everyone in here is already has it. So I'm going to continue with the training, but if for some crazy reason you don't have the income machine, we will cover that here shortly, and it's going to do all of this crazy work for you. Holy crap. Guys, what do you think? I'm seeing all kinds of chats from people who don't have it yet. Guys, I feel like I'm going into dad mode here. What are you thinking? David, Matt, another David. What? Okay, we will cover that soon. Guys, naughty. Okay, we will cover that. Let's finish the training first. Okay, so what actually happens in this scenario, right? So this is the scenario. Let's say you have 14 days and you have 2% of cushion. You have all these different scenarios. What is actually happening in these different scenarios? Well, like I said, anytime the stock finishes above our line in the sand, we win the trade. That's a winning trade. But how? What is actually happening here to give us a winning trade? Well, setting up this trade is a call debit spread. Okay, so when I say we have cushion here, what I mean by that is we've created a line in the sand using a call debit spread. Now, you could do this in some other ways, but I'm going to stick with the call debit spread because that's my wheelhouse. That's what I love to do. There's some reasons I love to do it that way, and we can talk about those later. But for right now, I'm going to stick with the call debit spread. So in this example, we've created a line in the sand using a call debit spread. What that means is that we've sold a call right here, 2% below. We bought a call below that, and now we've constructed this trade. We always use the same expiration date, okay? So we're always using the same expiration date when we do this, June 27th on both sides. And of course, we're always using the same type of option. So both are calls here. It's not one's a put and one's a call. They're both calls. And when any of these outcomes occur, the trade expires in the money. Okay, so this is a little nerdy. You don't have to understand this right away to start using it, but it's nice to understand it. When I say that a trade finishes above our line in the sand, what I'm really saying is that it expires in the money in practical terms. Here's what that actually means. Our ability to sell the stock at $100 is exercised. Why? Because in this particular trade, we sold a June 27th $100 call, and that gives us the ability to sell the stock at $100. When it expires in the money, anything above our line in the sand, that is now exercised, and we are able to sell the stock at $100. And our right to, our right to buy the stock at $99 exercised, okay? So again, our ability to sell the stock, that's exercised, and our ability to buy the stock at $99 also exercises. So do the math, folks. What happens if you buy a stock at $99 and you sell a stock at $100? You buy it at $99, you sell it at $100. What's happening? Hopefully, we don't need to get our calculators out for this one. You're making $1 per contract or $100 per contract. And that's exactly what's happening anytime price finishes anywhere above this line, you are buying at 99, you are selling at 100. You are making $1. You're making the full value, the $1 value of the contract. Okay? And the best part, this is my favorite part. This happens automatically as long as your trade finishes above the line in the sand, meaning you don't have to do anything. You don't have to exit it. You don't have to call your broker. You don't have to wait for a signal from me or opening playbook to say, hey, I think we should close this. Hey, it's going to expire in the money. Do this next action. You don't need to do anything at all whatsoever to collect the full profit. All right. So hopefully that's pretty cool. You set up the trade, you give it a whole bunch of different scenarios to, finish and get ahead of it. And in every single scenario where the stock finishes above this line, you will now collect the full value of the spread. In this case, it's $1. So let's just do hopefully this makes sense, but let's just do a little math here for everyone interactive on the call, because I know some of you are brand new to this and you might be thinking, I kind of get the logic, but I'm still a little thrown off by what's actually happening here. So let's just do it together. Let's just go through an example together, folks. Okay, here's a stock. It's going up. We want to put a trade down here. We want to get a nice, big, fat cushion. Now, this time, just to throw you guys off, let's say that we do a $5 spread. Okay, so we sell, that's what the S is, we sell a $500 call. And we buy a $495 call. Okay, so we sell a $500 call, we buy a $495 call. Now, what we pay for that is really important. That's what's going to determine those risk to reward metrics I was just talking about before. Let's say that we pay $350. That's what it costs us to put this trade on, $3.50. Okay? So, let's run through it. Our expiration date is over here on June 27th, and the stock goes down below our level, bounces up, goes down, and then finishes over here on this expiration date. Someone in the chat tell me what actually happens now. What does the broker do? Again, you don't do anything. What does the broker do, and how much money are we getting on the trade? Let's just think about this practically. I switched it up on you and I gave you a $5 spread now versus the $1 spread. Well, what's going to happen? Same exact function, right? What the broker is going to do automatically is it's going to give you the right to sell shares at $500 while exercising your right to buy those same shares at $495. If you buy shares for $495, you sell them for $500, you just made $5. You paid $350, you netted $1.50 per share. That is your profit. About a 33% ROI on that trade without doing a darn thing, and even if the stock went sideways or down a couple percent. Okay. Oh, you guys are on it. All right. You guys nailed it. 500 minus your debit, 500 minus your debit, $1.50 profit. Kelly, LK, $150. All right. Let me see who was the first one who put in there. All right, Ron. Ron's computer was the first one with the 150. Ron, send me an email. Ron, I'm going to send you an opening playbook sweatshirt for being the first one to get this right. So, Ron, let me send you my email. I'm going to chat it to you. Email me, let me know your size, and I will send you an opening playbook shirt, and you can rock it anytime. And think of Mike G says, "Way to go, Ron, in your computer." Anytime you think about debit spreads, you can wear the opening playbook hoodie, and actually, it's not a hoodie; it's a crew neck. It's actually really nice. My wife is already trying to steal one of mine. That's how nice it is. But So now let me ask again, does this make sense? Give me yes in the chat. Do we all kind of get what we're doing here, how we're staying below the price, what happens when we get in the position anytime above the price? Beautiful. Okay, got it. Yes, yes, yes. Okay, love it. Now, let's go back to this for just a second before we do a demo of the income machine and walk through it. And yes, it is, Mark, it is per contract. It is per contract. So if you paid 350, if you did 10, you would have paid 3,500 and made 1,500 per contract. Exactly right. I've got a lot of questions about why someone would be interested in making 14% on some of these more conservative combinations. Like, oh, why would I hold a trade for 35 days to make 14%? Like, that's boring. Why would I ever do that? Well, first of all, I think we've gotten a little spoiled here. I got to be honest. I got to be a little bit honest here. It used to be in the old days, in the old, credit spread days, that anytime you could make 5% on a defensive trade was like a good thing. And now people are like, 14%, boring. I'm not interested in that. So I think the first thing to say is we've got a little spoiled here in terms of the way that we approach trades. To me, you give a stock, a good stock, not any stock, but a good stock, 7% of buffer room and make a 14% ROI. I think that's actually pretty good ROI numbers. In most cases, I'd be pretty happy with that. But the idea here, and this is what's really important, is that we're targeting a 90+% win rate in these scenarios. So what's really important, guys, is you're not just factoring in the ROI combinations, with the 7%, with a 1%, or a 21% with the 5. Not just those combinations, right? But you also have to consider the win rate associated with these combinations. Okay? So let's just run through the math real quick on this because I do think this is important. So let's imagine a 10K account where you're going to risk 2K per trade per week. So that way you kind of have all your capital deployed over the course of 5 trades at any given time. So you trade, week 1, you put 2K out. Now you have 8,000 left in cash. Then week 2, you put 2 more out, but the first trade's still running. Week 3, 2K more. And by week 5, now your first trade is starting to close, but you kind of have all your capital deployed over a rolling basis. Now, the reason that I would typically recommend that instead of opening 5 trades today with all 10K deployed is that if a new liberation day happens tomorrow, now you've got all your trades subject to the same market conditions versus on a rolling basis. So before I go into the math, let me just ask one more time. Does that make sense? I know I asked you guys for feedback a lot. Bear with me. I like to think I'm not talking to myself. And so I always ask for confirmation. I just want to make sure when I talk about rolling, that's what I mean, that you don't have 5 trades all subject to the exact same market conditions. Okay, cool. So good. Yes, yes, yes. Okay, perfect. So let's be pretty conservative here and say that you win 9 out of 10 trades and you take a full loss on the one that you lose. So it looks something like this. June 18th, you take a trade. June 25th, you take a trade. July, 9, 16. By this point, you're starting to redeploy the first capital. Now you're redeploying your other capital. You know what I'm saying? So at this point, you're rolling through the trades here. And even if you take the full $2,000 loss, you end up with about $520 in net across 10 trades, which I think is pretty conservative. I mean, if you're giving a trade 7-8% cushion, hopefully you'll be able to win about 9 out of every 10 trades in that scenario, and you end up with right around $520 on a rolling basis. So that's 5.2% on a rolling monthly basis, taking the most conservative type of trades. This is obviously giving it 7-8% of cushion, going for that 10 to 14% ROI, sometimes a little bit juicier, sometimes a little bit less, but I use the 14% because that was about what the average on the most recent conservative trade was. And you're just kind of rolling those trades over. Now, obviously, you're not always going to win 9 out of 10. It's not like static. Hey, every month I win 9 out of 10, or every 2 months I win 9 out of 10. you might win 7 out of 10, and then you might win 20 in a row, right? So I'm just kind of giving you a basis here. Hopefully everyone, that makes sense. Well, the thing about 5.2% a month is that you're almost going to double that account in the first year, even at 5.2%. That's a whole account basis. So you're at about 18,000 bucks here after 12 months of rolling on 5.2% per month. I don't know about you. I think that's pretty good. Again, I think we've gotten a little bit spoiled over the years with flashy numbers, but I'm talking whole account here, not one trade. I'm talking about whole account here being almost doubled in the first year using that basis. Doug, that was using $2K per trade. So that's rolling $2,000 so that you gotta kind of get your full capital deployed. Crazy enough, you would be on pace to 20x your account in 5 years. So year 1, 18, year 2, 33, year 3, 62, year 4, 113, year 5, guys, you've about 20x your account on the most conservative setting if you hit those numbers. If you hit a 90% win rate with a 5.2% compounding. Again, I'm not saying, you always hit 9 out of 10. There's obviously whatever, but it's one of those things where the numbers are pretty interesting. So LK, great. Okay, so LK, good question. So LK said, "Oh, geez, if it takes 7 trades to recover 1 loss, not great. Why not use a stop loss?" Okay, so this is where LK, I would actually disagree with you. Now, a lot of people would agree with you. Okay, so I'm not saying you're wrong. I'm not saying you're wrong. I'm just saying I would actually not agree with you in this particular case. It sounds bad to say you need 7 winners to make up for 1 loser. I agree. That sounds bad. To me, that's actually fine. If you take 10 trades and every single month, 8 of them are canceled out because you have 7 wins that get canceled out with 1 loser. So 7 plus 1, 8 trades you take 8 of your trades to break even. But out of 10 trades, 2 every month stacked towards your net profit, I'm actually 100% fine with that as a systematic model. So this is, again, okay, I'm not saying you're wrong. Lots of people would agree with you. But for me, I would actually say that's great. And the reason I would say it's great is simply because the systematic numbers would have you 20xing your account in 5 years. So you would essentially be trading at a clip better than the best hedge funds in the world if you were able to achieve those pretty conservative numbers, because most people would agree. They would say, oh, 7 winners get knocked out with 1 loser, count me out. But again, I think that's a limited way to look at it. I would say, well, actually, in that result, you get 2 net wins per month on a rolling basis, which gives you some pretty incredible ROI numbers. That's me. Not everyone agrees with me. And the cool thing is, to LK's point, I'm not telling anyone they should go with the most conservative approach. I'm just trying to show you how powerful 10 to 15% ROI with the right win rate. Okay, so this is important. You got to have the right win rate. Okay, 10 to 15% ROI with a 60% win rate, not going to do you any favors. You got to have the right win rate. And so for me, the key goes back to these 3 questions. How far below price do you go? How much time do you give the trade? And what is the risk reward you get with that combination? So to me, that's still the whole key. Where do you get the most cushion? Where do you get the max amount of time? And what's the risk reward that you get? Jason, would I put a stop loss? Jason, I absolutely would not put a stop loss on the way that I trade. I'm not saying you shouldn't. I wouldn't. The reason that I would not put a stop loss on, let's just go back real quick to answer Jason's question here, and then I'll get into some of the detail here, is if you're taking a trade like this, where you're going to give it, 4% cushion, you're going to give it 21 days. And on day 1, the stock drops 2%. you're going to be taken out with the trade. Even though, Jason, according to the math, 80% of the time that trade's still going to win. Even if it drops 2% on day one, if you have a 4% cushion, 80% of the time that trade, even though it looks bad on day one, is actually still going to be a winner. So I am not willing to take a loser when 80% of the time I could have a winner. So for me, what I want to do is I want to use the max amount of time to my advantage for this to get back and finish above, or even just stay flat, or even just go down another 1%, but still give me a winning trade. For me, Jason, I am trying to use that time so I never, ever, ever use a stop loss on these type of trades. I also just don't like the fact that stop losses are too easy to get taken out. You get a wide bid and ask. The market tells you, hey, by the way, you just lost $5,000. And you're like, what do you mean? The stock barely moved. Well, it was in the options market that they just took out your trade. Super annoying. I hate trading when I get taken out of a trade that I don't want to be taken out of. And so for me, I never use a stop loss for that reason. I'm not saying that you shouldn't or that you can't. Just my approach is to actually use all of the time and try to get it to a situation where it's going to finish above my situation, above my line in the sand. Okay. So again, to me, I want to get this combination right. So the income machine, this is what the income machine is all about, guys. The entire concept of the income machine is to get me on the right side of these combinations, 1, 2, and 3, on the right side in real time. By the way, not on random stocks, but on the best stocks, which is really important. And then also let you choose the path that's right for you. So you've heard me just droning on and on and on about the income machine for 6 months, really, but especially the last couple of days. That's what it's all about. What I've showed you today is what the income machine is all about. Because if you and I want to look through all of these combinations, we literally couldn't do it. The trading day would end before we looked through all the combinations. But the income machine is going to run through millions of combinations to find the best balance. So you and I might say, hey, GE, we like the 14-day out. We like 2% cushion, and we can get a 16% ROI on that. Pretty darn good using the basic, debit spread that we found. What the income machine will do is it will say, hey, I bet you didn't know that if you go 21 days and you do these weird strikes where you get a 2.2% cushion, you can ramp this 16% up to a 23%. It can find that when I would never, ever find that because I wouldn't look through all those weird combinations. And it can give it to you on a silver platter to find those opportunities. So that hopefully I'm making sense here. I know I'm kind of talking theoretical about these combinations, but guys, hopefully this is making sense to you why the income machine is so powerful, because it can find the combinations that, frankly, I would never find on the best stocks with the best cushion, with the best risk reward to give you all of those opportunities. So if you have not used it, which I can't believe how many of you guys have said that you have not used it yet, well, today you'll get a chance to try the income machine absolutely free. So we'll cover that next. Hopefully the training already gave you some big light bulb moments. Give me a yes in the chat if you had some light bulb moments by looking through those combinations today. And if you had some light bulb moments, well, then I think the income machine will absolutely blow you away. So over the last year, guys, I have been obsessed with trading this way. I had the overnight options, which has about an 80% win rate. We've had automated options with about an 80% win rate. Two-way options with about an 80% win rate. Weekend options, which has 100% win rate so far, all using versions of this idea, these defensive trades. But over the last 6 months, I have really been working on something that I have never, ever done before, that I think is an absolute game changer at a level that, in my very biased, yes, I will admit, very biased opinion, is the biggest game changer in trading options that anyone's ever built. I mean, I really fully believe that. And I really think that the core problem that it has solved that no one else has is that you're not boxed in to a single approach. Okay. Most approaches are either built ultra conservative or they're designed really high risk. And you kind of get one structured system within that. No flexibility, no middle ground, no way to adjust the opportunity based on your desired approach. Or even the ability to, shift your risk appetite like I do based on different market conditions. But what if there was a way that an income system could do a lot more? Targeting 250, 500, $1,000, kind of based on those scenarios we were talking about where you could choose a path. Well, that's exactly what the income machine was programmed to do from